So, hello. Today on the Rupee Roundtable, we spoke to Maninda Wickramasinghe. Maninda is the country director for Fitch Ratings. He's been one of my first bosses and continues to be a mentor through the years. So, we got in the big rocks pretty early in discussing Sri Lanka's timelines with market access. We also discussed rating methodologies, the DSA targets, and what sectors would prop up most in recovery and the painful road for recovery. And I hope you enjoy this conversation as much as I did having it. Hi, Maninda. Thank you so much for doing this. And I'm very excited to talk to you. And you're the man in the driving seat for our ratings. So let's start with the big rocks themselves. This is the big question that everyone is pondering. Sri Lanka's access to markets. How soon do you think that will happen? And what's the road there?
Thank you, Nikki, for having me on your show. I also, at the outset, want to say that some of these views are mine.
Sure.
And not necessarily represent the organization I work for.
Of course.
And with that, let me try and answer your question. So we are in RD, restricted default now,
sure,
as far as the rating is concerned. And the question that was asked is, how soon can we access international capital markets? So the way I would put it is, you need a minimum of a B- rating, which is 4 notches above where we are, to get back into access to capital markets. Also, B- does not necessarily mean immediate access. It's also be viewed as to how sustainable your debt is. Don't forget that we had people who subscribed to this debt when it was not sustainable. So yes, we've had issuances even after downgrades, where we indicated in 2016 itself that the debt was not sustainable. So in that sense, there'll be a lot of investors with different risk appetite who will probably tap into these markets. But for us, at least a minimum B-. And if you were to look at a timeline, that can be anything from 3 years from now. So, or even long. A lot depends on how we vis-a-vis address our own problems, and also how global markets react and operate. Some things are not in our control, but some things we can control. So in the meantime, what does one do to access finance? So hence we tend to talk to multilateral agencies, because they would then look at programs, specific programs to fund. We've had Asian Development Bank funding budgetary finance, support finance. So like that. But at the same time, when we look at an economy, it's very clear we have revenue options and revenue sources. So it's how we set about obtaining or enhancing those revenues. So those are also important for the ability to service debt. Now, in a debt restructure program, you may have a moratorium, which may initially give you a moratorium of payment of capital, but we may service interest. So there are different methods, but we are yet to see what the final outcome is. But definitely a debt restructure program would be important. And with that, we also would be able to build up our own reserves and build confidence, market confidence. And we also need to think, what is it that we did wrong before? So if you look at that, there was a point where we had a capacity to borrow and build. When you borrow and consume, that's where it goes wrong. And then, of course, you would then have to look at continued growth in your revenue.
Okay.
So if your external, particularly things like Sri Lanka has been dependent on remittances, export earnings, and a trickling of FDI. So we can clearly improve on all three fronts. I would think that as a rating agency in particular, we look at things like remittances as being volatile.
Okay.
So in a risk perspective, that's considered volatile. It can dry up very quickly, as we saw. So what is actually important is foreign direct investment, because that's a sustainable investment. Whereas any capital market inflows can move very quickly out, like into the stock markets, into bond markets. Similarly, remittances can dry up. So it's important that we build that kind of confidence to look at the longer term. And now when you do that is when financial intermediaries would look at Sri Lanka favorably and look at financing. So for now, I think what would be more critical is how do we develop a domestic debt market, because the banking system is obviously very stable. Whatever that during an economic crisis, one of the most important things is your banking system. And I think Sri Lanka did a good job in stabilizing the banking system.
Sure.
And actually the banking system is stable. We had a negative outlook. Now it's stable. So clearly that's a good sign, and which also means alternate to banking funding, we should look at domestic capital markets. And that's where we have failed. I think those markets lack depth. They need to have multiple sources. There is no capital formation. Any long-term capital formation is in superannuation funds, most of it. So how do we unlock some of that to be able to channel some of that into our own investment program? And that's I think the key. So we need to have access to those markets. We need to have proper systems to eliminate systemic risks. And the building blocks for capital market is you have low-cost long-term funding, and that has to be sustainable. What we have not seen is a steady interest rate that can facilitate such long-term borrowings. We had very volatile interest rate cycles, and they are more like boom and bust cycles. That does not help. So these are very important in terms of driving confidence.
So we see we've seen a downward sloping. We've seen interest rates coming down, but we are yet to see a meaningful recovery in private credit. What do you think could catalyze that? What are we missing?
Right. So I think we need to look at Sri Lanka and its competitive advantages. If we think we can go back to what is called business as usual, I think we are not being realistic. Sri Lanka has to look at where do we have those advantages and start exploiting it. And when I say exploit, we need to have the private sector in there. Now, when I say that, like I mentioned that, for us to go into international bond markets, see, international capital is expensive. Mm-hmm. Plus, it's also, there is risk because we have to repay. And there is always pressure on currency risk, as well as you have the risk of rising interest rates. US interest rates are currently quite high. So this is why I say that we need to also look at our domestic markets. And while we look at it, if you look at a country that has as an enabler, we should look at enabling the infrastructure, and the way that can go is to look at public-private partnership. One of the lowest hanging fruit for PPPs are energy sector. Now, the energy sector, we could have attracted private capital on a private and a public-private partnership 20 years ago. Even then, it was possible. Around the time when India seriously undertook PPPs to build their infrastructure, would have been a perfect opportunity for Sri Lanka also. So, having learnt or having no access to capital now, and depending on bilateral and multilateral lending, this is an opportunity we have where we ask the question, do we create the infrastructure that enables our economy to move on, or do we want ownership? I repeat this, I've mentioned it before. We need to basically look at a model where it serves our growth purpose, creates employment, creates growth in an economy. We don't necessarily have to own the asset. And the asset can be on a build, operate, own, build, operate, transfer. There are so many models. So that's perfectly fine. Lots of countries did that. Even we keep harping about, how well Singapore has done. Singapore had no access to capital, but that's how they did as a small city-state. So I think there are plenty of examples. And domestic markets also improved a lot post-crisis in Asia. If you look at 1997 East Asian crisis, all those economies, their domestic markets are deep and much stronger. So we have a lesson to learn from there.
So I'm going to wheel back to interest rates. Now, we will probably see 3 rate cuts this year, both from the Fed and the EU. And how important do you think? What is the role of the monetary board in what should they prioritize? Should they be looking at keeping a stable interest rate that attracts investments? Or do they should they be prioritizing catalyzing credit growth internally?
So the interest rates is an interesting tool, while it's also an indicator at cost of capital or cost of borrowing, whether it's working capital or long-term capital. Now, what we've had, as I said, is boom and bust cycles. So what a business wants, or anyone who's engaged in an economic value add, is looking at a stable interest rates where he can forecast or predict costs. At the same time, an exchange rate which is also, if it can be stable, would also be more predictable. None of them are predictable in Sri Lanka. I mean, our track record is such that now maybe we need to think on those lines, because what you want then is a predictability in your cost structures. And then once you have that, you can look at a return and your revenue targets, and that's how, and taxing any extraordinary profits from there is fine. So we have had even businesses going through these cycles much more rapidly. Once in 2 years, 3 years, we have interest rates that go sky high, and that affects everyone. That basically just slows down, decelerates all your growth potential. And of course, anything like kind of exchange rate depreciation like we had means your assets are already halved in value. So those are cycles from which recovery is going to be extremely slow. We should not expect huge and meteoric recovery from such a scenario, but take them a step at a time. I think the rates are low and that stability is important. So bringing the interest rates down also needs to be looked at vis-a-vis inflation targets, vis-a-vis the exchange rate, because as you know, if you have a rupee too cheap, you can have a problem again. Which we need to look at it as there is a balancing mechanism in this, and that is essentially the interest rate differential and the inflation has a bearing on your exchange rate. So we need to also look at, one of the largest bills that we have to pay is for energy. So if you address your energy mix and look at renewable energies, for example, maybe the outlay for energy in terms of oil or import of coal could be reduced. So those are all positives towards a more sustainable model. But for a business, predictability is the most critical thing. And your question on credit growth being slow, of course, if you look at as a sector, the tourism sector has rebounded pretty well, and almost the supply chain clearly related to that area is probably performing, and there is growth in credit. They're probably also servicing their debt. It is the other areas where growth has, particularly in exports, garment exports is muted. I believe maybe even a 30-35% drop. So these are areas where a rebound can happen, and then of course there'll be credit expansion. But like I said at the initial stage, we need to look at things like as competitive advantages. I would say, for example, IT sector is an area which we need to and we can grow. We need to build resources. If you talk to an IT expert or anyone in that field, will say Sri Lanka has the capability, but we lack resources. One of them is IT engineers. The market requires, say, if you want to be a serious hub in this spec, we can't compete with India, but certainly we can do much more value-added services. And in doing so, if you require 20,000 annual in terms of capacity for engineers, we produce about 6. So there is a huge gap there. So these are some things that we should address. And if you look at tourism, I think the investments are already in. So it's a question of improving on some of the infrastructure and the services. And that is for us a low-hanging fruit to exploit and sustainably exploit, because that's the key to long-term growth and sustainable growth. And similarly, I would think fisheries is another area that can develop enormously, and we probably don't exploit our 200-mile economic zone. I sincerely hope others don't. But these are serious areas where you need investment, and we have a lot of opportunity. And again, modern agriculture, rotate crops, look at new crops for export. All of this, because we have abundance of resource of water, we can rehabilitate some of those tanks, channel irrigation. So these are the growth sectors. And once you have those in place or as being exploited, that's when you see sustainable credit growth. And we need to be ready for that.
So looking at the depths of the abyss we were in 2022, is there anything that surprised you in our recovery? What are the sectors that led, in your view, the surprise element?
I think the key element was recognizing that we can't sustain our subsidies. That's the biggest, I think the biggest and the most difficult move Sri Lanka made. And it took a crisis to be able to do that.
Sure.
That's really the answer to a lot of questions. So it has created an enormous burden on the population at large. But, well, if we hadn't done that, sure, you will have serious pain over the next year or two even. But I think if we get it right and we continue some of the reform agenda, I think Sri Lanka has a wonderful opportunity for a long-term sustained growth model, which is what we have not had. And I think we need to see this through. And what we have, this is one aspect. When you say surprise, sometimes a crisis precipitates it. The surprise is that we went through and the whole almost removing almost all the subsidies that we had, and now we have a pricing model, and people understand and also accordingly adjust. So we are certainly seeing a lack of disposable income, because naturally when you have such trigger movements in electricity, water, all of that, all of a sudden you have to find you have to divert your income sources to manage that. But I think in the longer run, the economy with higher tax revenues, you will see, would have probably a more sustained model that we can continue with. The other area that was always expected in terms of a rebound was tourism. Tourism also has done better than expected. And we, I think, have to understand that we have achieved some of that in the backdrop of we did not have a lot of major airlines flying in at the time, but we now have most of the major airlines flying into Sri Lanka. We also have a backdrop to higher airfares because oil prices are high and the airfares are high. We also have a problem of airlines having lack of capacity because over COVID, lots of airlines grounded planes, and to get them, it's been a challenge for a lot of the airlines in the region to get them all up and flying. So capacity was an issue. So in that backdrop, what we have achieved has been pretty good and probably better than expected. And tourism has a good multiplier effect on the economy. If you look at Sri Lanka, countries like Sri Lanka, converse is also true. If tourism declines, it affects a large segment of the economy as well. But on a rebound and a sustained growth, I think the multiplier effect to the economy, particularly on the supply chain, is actually very robust.
So Maninda, going on the recovery topic, and particularly given the fact that our turnaround in the fourth quarter being considerably better than consensus expectations, and also our reach to IMF happening in March, which I personally thought we might not be able to. I thought it could reach it would drag as much as far as June. Two very positive incidences back to back. How would you think that will impact on a rating universe, particularly the biggest beneficiaries being the financial sector? Would you like to comment on that?
It's a good question. I would think for if you look at the drivers, rating drivers, particularly when we issue reports, we have what you call positive drivers and negative drivers.
Yeah.
So we have clearly illustrated in terms of external debt, in terms of domestic debt, and the budget deficits we ran. These are very critical in terms of what Sri Lanka has to do. I think we have addressed a lot of those issues related to domestic debt.
Yes.
And we have done probably a lot better in terms of some of those reforms. I think clearly we have undertaken SOE reforms, and including the sale of some of those assets, which of course they are in the pipeline, but we are yet to see bear fruition, those will be looked at as positives for in terms of positive credit as far as domestic economy is concerned and sustainable domestic economy. What a rating agency would now look for is what is the external debt restructure program, and finally, when we sign off on it, how does that look in terms of our external credit profile? That will determine where the rating moves. But of course, once we sign off on a debt restructure deal, the rating will no longer be at RD. So the rating will have to move, but the question is how many notches. A lot will depend on terms of some of the agreements. And also, as you know, for a rating agency, we look at a sustainable model, and we have looked at a track record. Sri Lanka has not had a very good track record in a sustained, stable macroeconomic management. Just to illustrate one, we have been to the IMF. This would be the 17th time. So clearly we have not been able to manage our economy. So then more than the intent, a rating agency would look at action items. So they would like to see some of those initiatives bear fruition. And I think the steps that we have taken are in the right direction. I think we have engaged with some of the multilateral agencies to undertake the SOE, some of the SOEs that are up for sale. And they are looking at process management and all of that. So that's very good because it also sets benchmarks to the way you do things and in a transparent manner. But in terms of, so these are some of those building blocks for improved credit profile. And sure, when you have the sovereign rating improve, and as I said, well, we'll have to see how many notches that moves up, but that improvement will have a bearing on its ability to support an economy, which was factored as being very low. So everything else that centers around that would then also move up along with it. So that's the upside that we have. I mean, when you are in a restricted default, you can't go any below that. So question is how long? And I have to say that Sri Lanka there are plenty of countries in the African continent and in parts of South America that have probably had similar defaults. We, I think, have done quite well in getting off the blocks in terms of a turnaround. And that's been a big plus for Sri Lanka.
On emerging markets, there was this thought that when a frontier market recovers from a catastrophe, and say when the sovereign grows when the economy grows at say X%, it's said that the banking system grows at 2x, absolute rule of thumb, and the NBFI sector that's closer to the grassroots grows at 4x. Is that something that you've seen in recovering comparable economies? Can you strengthen or break this argument?
So I would put it like this. If you look at, you had a question earlier about credit growth being slow.
Yeah.
It's very clear that we have a import ban on motor vehicles. Motor vehicle financing is a very large component.
Indeed.
And so you can see now that is. Motor vehicle financing is a business opportunity. but that can't be your model for credit.
Sure.
And so we have to be more diverse in looking at what we find. So whether you're financing for consumption or whether you're financing the real sector. When I talk of competitive advantages, I'm talking of financing your real sector. And when you finance the real sector, and yes, then probably once you have a very robust and a more sustained model there, certainly that would, any consumption financing would be an added bonus. But the sustained part comes from your real sector financing. And that's what banks and capital markets are. They must finance the real sector. Margin trading, for example, or trading on stocks, that's a capital market. You can't run credit purely based on financing assets like that. And that's not a sustained model. So
Correct.
we need to look at a far more sustained model of what we finance. I mean, those are opportunities, but that cannot be the basis on which credit runs, or you run a spread between lender and borrower.
And it would probably also depend on how deep the impact on wallet sizes of the masses, of the middle classes. Yes.
Sure, I think the banks are very liquid at the moment.
Yes.
Because people are being careful. So they are certainly definitely saving, mostly kept in the bank because they are probably looking at a rainy day kind of situation rather than consume. So consumption is clearly low. But at the same time, it also is an opportunity to, this is where we need to look at the small, medium-sized businesses. They also follow a boom and bust cycle. They boom and they go bust because they don't have access to capital, nor do they have the buffers to survive. So they just fold up. This is an area which we need to seriously address. And you need, I'm glad that government as a policy says that they want to build a development bank. Well, we developed a bank called the National Development Bank in 1979 as a policy bank. And in 10 years or little more than that, policy bank was converted to a commercial bank. So we have come now 360 degrees to a point where we say we need a development bank. Okay. At least now it's understood that we need an institution that can nurse small to medium industry to take them to the next growth stage, which they are sustainable. There are plenty of examples during the NDB cycle, when I say NDB as a development bank, where small and medium industry was sustained and they grew to be the bigger, and plenty of examples of that. But since then, we haven't had many. And clearly there is a missing element there. So
I agree.
This is important, as I said, for your new model in terms of credit growth. And it is that sector that is clearly important. I don't mean by small and medium industry as merely trading. Import and trading has no value add. It's an important in terms of, as I said, in terms of consumption. But the real value add is those who use more of domestic raw materials and can add value for export, or for that matter, even in a domestic market.
Now that you touched the possibly lifting the ban on the motor vehicle imports, I think there's a possibility of that happening, and it's also very likely that if it's happening, it will not happen at the high end where most of the demand lies, but it will happen at the lower end, smaller. I think it's 1300 cc or less, or smaller cars, where the demand is significantly lower, and I think that's the right thing to do. Given the current improved forex liquidity that we have, say going forward, we would until 2027, I believe, we would only be paying multilateral debt. We would only be servicing multilateral loans. Do you think this is a possibility? If so, do you think that's a good idea in terms of managing forex liquidity?
As a policy, I have a question. Sri Lanka has such high tariff rates for an import of a vehicle.
I think close to 50% of all our taxes came from border taxes, and a big
if you
portion of
have
that
cars. Tariff structure,
yeah,
that means as a policy, what the country is saying is, we don't really want you to bring this vehicle. Right? It's not an encouragement, right? But if you're paying that kind of a tariff and bringing a depreciating asset, right? To me, that is not sustainable. So, what is also important is there is no value add in this import of that. Sri Lanka needs to look at whether we could do anything in component manufacture or any value add into this industry. And I think there lies opportunity again. We have a huge market next door, and this is a technology that's changing very rapidly. And so if we look at what is it that be affordable, what is affordable, I am not saying that we should not have cars and people have convenience, but affordability, in my view, for an economy like this, we must have a robust, proper mass transit system. Then we look at private vehicles. If we open the floodgates, we will be just congesting the cities, and we would have to probably spend billions in building infrastructure to make that mobile. With that kind of a resource, I think we can definitely use mass transit, which we have miserably failed. And so we need to look at that model. And I would think that government has clearly indicated, like I said, the policy, the tariff structure is that, if you want to bring a motor vehicle, it is going to be expensive.
Sure.
So those who can afford will bring it. But then what is not right is if you have a system that facilitates bypassing that policy, which is the kind of permit regime that we had. That doesn't make any sense, because you are also saying at the same time that for everybody else there is this huge tariff structure, and then you have a system that bypasses it, which everybody can benefit. So I believe that the permit system has stopped, and I think that is again in a quasi-subsidy. So that's off now. And I think vehicle imports, probably now, if you were to pay the regular price and bring it, would probably be maybe much more balanced as opposed to before. Same time, we are now permitting electric vehicles. I would think that while we are looking at electric vehicles as being environmentally friendly, there are arguments to say that when you talk of electricity, that comes from the grid, and I don't know how much of the grid is sustainable. So comes from probably burning fossil fuels currently. So energy mixes, carbon footprint needs to be looked at. Also when you're looking at that. And I would think we need to, if you're looking at green economy, we need to look at it in a wholesome manner.
Can we look at your thoughts on the credit negotiations? I think we've made phenomenal progress with the OCC and the private creditor negotiations, and I think a very likely scenario is that we would get get a 6-year moratorium with India and Paris with the Paris Club. Although I would have preferred a 10-year moratorium. Do you think that's possible? And if that happens, what do you think we should? How do you think we should optimize it?
So, when we, as a middle-income country, and we did not have access to low-cost, long-term credit, particularly from loan agencies, we knew that we would have to go to capital markets. Bilateral is, or for that matter, any credit, it's not a free lunch.
Sure.
So bilateral, the fact that we do have multiple countries that have lent money to us also comes with terms and conditions. So sure, if they are, I think it's a question of how well we can negotiate, and depending on that, if, as you say, wishful thinking, if you can get a 10-year moratorium. But I think for Sri Lanka, if we do get that kind of moratorium, and then we only have to service multilateral debt, and that's a window where it might give us time to actually realign our economic strategy, and get into a export-oriented, whether it's a service export or manufactured export, re-strategize, build a stable, because there is the opportunity then, without having this external debt servicing pressure, where you can realign your economic strategy, I think is a wonderful opportunity.
So, Maninda, what are the DSA targets that you at Fitch are looking at, and how they differ from IMF's own?
Right. So, IMF is a lending agency.
Yes.
And the way we look at it is different. We are, as a credit rating agency, we have a model, and depending on the parameters that we feed, the model tells us because we don't look at a history, we are looking at a rating is forward looking. So we assess ahead. So in 2016, we said that is not sustainable already.
Yeah.
So that's what we mean. And in 2016, we were in an IMF program, or we signed one. And then we also then get into another one. So we didn't, I don't recall whether I don't think we even completed that program.
Didn't.
So clearly the lending agency's approach is different to ours. So therefore there can be that difference. But what we do take comfort in is when you have such a program, particularly in countries where we have obviously not had consistent policy, and that has been a problem for Sri Lanka, in lack of consistent policy. The program itself gives you some kind of guidance in terms of what to expect. So as long as we stay in a program, a rating agency would probably take comfort. It's not that they don't look at what are the other indicators, but in Sri Lanka it has been difficult, because this would be the 17th time we have gone into an IMF program. That's why I meant also by saying that the rating agency would also look at actioned items, what has borne fruition. So clearly in a that's sustainable, if you look at particularly the domestic debt, clearly the debt servicing component, so even with tax revenue in the past, almost 60% of that revenue went to servicing your debt. So that didn't leave you much room for what a government needs to do in terms of running your institutions, all of that. So clearly we have to look at a couple of these in terms of in a reform program. One is, I think it's very important that when we have and we are asking people to pay higher tax, that there has to be transparency. How does the tax work for you? That's very important, because the everybody who should pay taxes, tax compliance must be high. I think Sri Lanka tax compliance is very low. I think government is addressing that.
Sure.
But clearly it has been like that for a very long period. So in this backdrop, now that you're addressing your revenue concern, then we have to look at it in terms of where is it deployed. Clearly the sustainable, we have to bring down that debt to a sustainable level. So one, of course, is if we look at where we have seriously, government has bailed out state-owned enterprises with debt. So that's a massive chunk that we should now think we need to have a mechanism to clear that debt and clean up balance sheets, and so that governments can also take a view as to what kinds of businesses they should be engaged in and what kind of businesses are left to private sector, because they would probably be more efficient. So the key element there is who creates the job opportunities. So government is saying that for them to create job opportunities are limited. So if it's the private sector, now it's the time to seriously look at this as a strategy. And private sector also needs to know, like I said, a sustained, stable macroeconomic background to being predictable in what they do. So this is where we are, whether we are at that moment where from here onwards, this would be that stable opportunity that we have. But definitely, we can't run at these high debt levels. So the reform program needs to run. The revenue, so in effect, we are like a highly leveraged company. When a highly leveraged company, what do? They deleverage. In our economy, we don't have even opportunities to deleverage. When I say that, if you want to address rebalance a balance sheet or restructure a balance sheet, we don't have mechanisms to do that. We don't have where we can even, I think there have been discussions on this for even like things like Chapter 11 as a law, where you can restructure companies and be operational. That's one option. The other is a asset management agency where you can park your debt and get refinancing. Those mechanisms are extremely important for Sri Lanka, and I think both in the banking system and in state-owned enterprises, there is plenty of debt that needs restructure, and it enables you to readjust your balance sheets and continue in this business, and you can then avoid some of these boom and bust cycles. So I think that's a very important aspect when I talk of capital market development. And the other is, as I said, even in debt sustainability, so that you can readjust and realign and restructure state-owned enterprises. And I think that's a key element to continuing. And then again, the government has to ask the question, how much can they keep financing? So if you have an education system, I think it's time to recognize that access to free education must be targeted. If you want
all the way down to tertiary.
It's something which I do not have in terms of stats, but technically you could, from the time you're born to your till you depart from this world, you could technically be receiving government handouts all the way. So we need to be able to target that, and that we haven't done. So we have different welfare programs, but that's not what I mean by target. So I think it's also important to recognize, like we did for telecom sector, we kind of liberalized it. We need to look at a more liberal policy framework, even energy sector, and where the basic benefits go to a consumer. We are price takers in this business now.
Are you in any way concerned about our DSA targets being a little loose, where we'd be able to borrow at very high levels and delude ourselves into thinking that it's sustainable? And also, in the past, say in the mid-80s, we've run very high, say 120, 125 plus level debt to GDP levels. But then again, that was concessionary debt, and that's probably the biggest difference between that time and now. How do you compare those two cycles?
See, there have been lots of discussion on debt sustainability and what we should be doing, and we haven't done anything in the past. And we've been lulled into thinking that everything is fine. And you can print money, you can issue bonds at any time. So I think there is realization now. The opportunity is there. The discussions have been there. And now it's a question of implementation of some of that. So there is no retraction from this position. If we do, the consequences of that we will know 5 years from now. We could have another default easily. So there are examples of countries that have had defaults and had serious restructure. They've had IMF bailouts, negotiations with bondholders. All of this has been going on for them to successfully default. There are countries in South America, they are now considered willful defaulters. And so we do not want to go there. Yeah. And I don't think that helps us. And we probably have learnt from our mistakes, and we must move on. And we need to, Sri Lanka has had a rating in terms of, Fitch has a rating of BB minus at its highest, while the others had it at B plus, one notch lower. We need to think that we should be better than that and strive to get to higher credit ratings. Then you have access to low cost of capital and you have multiple sources of it. And when you also start doing that, there'll be greater confidence in foreign direct investments into Sri Lanka, which we badly need. If we want to clearly balance the economy and look at a sustained model and also diversify it, we need that FDI. As I said, look at your competitive advantages, channel the FDIs into that, and that is what will get us through.
What do you think our debt future is like? Now that we've defaulted, we've turned around pretty well. We're looking at probably a quicker than expected access window.
Well, international capital flows might not come rushing in a situation like that. But if we do have an opportunity, certainly in capital markets, these are times when people who have appetite for risk enter the market. So you would have hedge funds. These are typically people with appetite for risk, emerging market funds. Only thing is, when we talk of all of this, they are funds of a large size. We don't have opportunities sometimes that, we don't have investment opportunities of that size.
Outside the SOEs, probably.
Correct. So we need to also look at, when we look at capital and channeling capital, we need to also look at how do we bundle them to bring manageable sizes or more like desired volumes, because you don't go to international capital markets to raise $25 million to $50 million. Usually it's anything above 150, 200 million and going into billions. Now, scale, we don't have scale. And this is where decoupling and as I said, open up infrastructure for investment comes with, because the government cannot get into, there is not much space for bilateral borrow and build type programs. So we will have to change that strategy.
Okay. On final thoughts, what concerns you? What worries you about our recovery? What could potentially keep us? What could potentially derail us?
Well, my worry has always been we've had so many pitfalls, and certainly from my youth to now, multiple. We have had civil strife here, and we've had more chaos than a country of this size ever has had to experience. But if one was to worry, now I would be really worried is whether a lot of the hard work that went into getting some form of a reform program underway, and also setting ourselves to look at more, in terms of a growth trajectory, grow the economy and also bring diversity into that, whether it's very easy to retract from there and regress as opposed to progress. So that is a worry, because in the past we have seen that happen. And if we take 2 steps forward, we take a step back. That is a worry for me, I would think. And I will worry because we will be soon at an age of retirement. And we are not in the job market. It's not like that we are looking for career advancement. But the youth in the country are. And they need to know where there is the opportunity, where is the employment opportunities, and how do they plug into this growth. So that's important.
Any outliers, any black swan events that you can possibly think of?
I told you opportunities that we have. So currently I can see we have built infrastructure. So I think they are assets of the state. Okay. We need to very quickly look at how do you monetize them, and bring about the benefits of that. And I think that is actually a wonderful opportunity we have.
Maninda, this was an absolutely brilliant conversation.
Thank you so much for having me on the program. And I'm glad that we've been able to have this chat.
Thank you. Thank you so much.